Is it a super cycle? Is it an everything rally? Is it just all happening at once? Some stories are linked, others might be idiosyncratic. But in any case, there is a lot going on across all sectors in the world of commodities. In this episode, we will highlight the biggest moves and the forces driving them across precious metals, energy, industrial metals, and agriculture. Welcome to the Commodity Exchange, a podcast where we bring you insights from the world of commodities. Whether you are an investor or just want to learn more about this topic, this podcast is for you. I'm Mobeen Tahir, Director Macroeconomics and Thematic Research at Wisdom Tree.
And I'm Nitesh Shah, Head of Commodities and Macroeconomic Research here at Wisdom Tree.
Before we begin, I do need to state the following. To clarify, the views and opinions expressed in this podcast are those of Wisdom Tree and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. So, Nitesh, with that, we have a lot to cover in this episode because we know a lot's been going on in the world of commodities. Now, when commodities rally, people get excited because it's not often, certainly it's not the norm when we see all four commodity sectors making gains over any given period. But we have seen this happening recently, and we will go into some of the individual stories certainly for different commodities. But how about we start at the high level, and what's your take on the big picture forces at play in the world of commodities, and generally, how excited are you to see some positive action in the world of commodities across the board?
Yeah, well, the short answer to your last question is I'm very excited because I think what happened is we went through most of 2023 with a lot of pessimism towards the asset class. A lot of people translated the high interest rate environment that we're in and the slow growing economy in China in particular to be something that would be a drag on commodity demand. Now, as we progress through 2024, we're getting more and more data, confirmed data, on the degree of demand for a lot of commodities, especially in the metal space. And that has been relatively strong and very resilient. And that's leading to upgrades in the balance forecasts. So balances across a lot of commodities are being tightened. And it's clear that, when a few months ago we were seeing a polarization in commodity market sentiment. We were seeing not only long, futures market long positioning increase, but we were seeing futures market short positioning increase as well. So the bears and the bulls were quite far away from each other. And as we're getting the data points that confirm some of the tightness, it's the bulls that are, it's the bears, sorry, that are losing out, and they're having to cover their shorts, which is amplifying the price movements on the upside. So I think that's one of the key features that we've been seeing over the last week or so.
So, Nitesh, in our last episode, which was a month ago or so, we spoke about gold being at record highs, and a month later, now, we can still talk about gold at or around those sorts of record highs. Now, gold was going strong when rate cut expectations were being pushed out, and it is still going strong now that markets are becoming more optimistic, perhaps, about rate cuts once again. What's your take on what's going on with gold right now?
Yeah, gold has been super interesting. The fact that we got continuous headlines of gold being at all-time highs, right? We got that earlier this week on Monday with intraday highs of 2,450, and that was kind of where my forecast for the end of the year was. So we kind of smashed that already. Now, what's happening with gold is yes, it had some assistance from slight depreciation of the US dollar, slight reduction in bond yields. That's helped lift it up. But the physical strength for gold is there as well. So central banks continue to buy the metal at a record pace. We saw in the first quarter of this year the highest Q1 buying of gold by central banks on record, and we're seeing a lot of demand for the metal coming from China. Um, they're buying through ETFs, and they're buying through you know, coins and small bars as well, and that indicates that investors in China just have a lack of other places to invest, and that makes sense in the context of a country that's had a real estate implosion, and the equity markets, although are performing now, it's possibly on the back of large amounts of state support through the national team. Um, so, gold in the context of China is the so-called Tina trade. There is no alternative, right? So people are forced into this asset class because of a lack of other places. I think that's a good support factor for gold, even though in my modeling process, the physical hasn't really been a key driver of gold prices historically. At this moment in time, it does look like we're stepping almost out of sample in terms of the demand from central banks and China in particular. But where does it mean gold could go? My forecast once again look towards the next catalyst really being those interest rate cuts from especially from the Fed, and the Fed minutes that were released yesterday doesn't indicate that the FOMC is in any particular hurry to cut rates, and that's why we saw a little pullback in gold prices today, which is the 23rd of May. But I think with every dip in prices, those two categories, central banks and China, are ready to step in and load up with more buying.
So, Nitesh, a related asset class that we always talk about whenever we mention gold is, of course, silver. And we've said this on the podcast before. When gold rallies, silver tends to rally. And sometimes when the two get into a race, silver can often take the lead. And perhaps in the last few days or weeks, we are seeing that happen once again. To me, I make maybe three observations on silver, and I'll get your take on it as well. As we record this on the 23rd of May, three key observations on silver. One, spec positioning has been increasing lately, but it isn't stretched by any means yet. It, on aggregate, if you like, on silver. The second thing, gold to silver ratio has come down pretty sharply in May, which means that silver is not as cheap relative to gold as it was perhaps a month ago, but the ratio is still fairly high relative to historic averages, which means that relative to history, long term history, silver is still perhaps relatively cheap compared to gold. And the third thing, silver, despite its strong gains in recent weeks, is not at record highs, as is the case with gold. Of course, silver made record highs back in 2011. Um, those three things to me suggest that there is perhaps more potential upside to silver in the sense that positioning isn't stretched, valuations aren't stretched, and prices aren't at record highs. How do you see the tug of war between the bulls and bears for silver from here onwards?
Yeah, great framing there. And I agree pretty much on all fronts. The silver rally does indicate that its correlation with gold is still there. Roughly 80% correlation, but when it goes to the upside, it tends to go that little bit more. So it was a little slow off the mark, and that's why we saw the gold to silver ratio accelerate earlier this year. But now it's back down, and we're fairly close to long-term historic average. We're not that far from it at the moment. And silver has hit an 11-year high, which is pretty remarkable. I've only been in the commodity industry for 12 years, so this is a bit of a rare moment for me to see silver prices this high. Now, if you look at spec positioning, as you say, there was bearishness earlier this year, and that's being recovered. That's positioning is now close to a standard deviation above its 5-year average. So it's showing bullishness, but not stretched bullishness. Just as you put it in your framing. Um, and the demand for silver is pretty strong in industry. We may see other quarters of demand, like jewelry, soften on the back of higher prices, but in industry, there's demand, and that's an indication that the world economy is quite resilient. It's less and less likely we're going to go into a recession. Even soft landing looks less, likely. It's probably going to be no landing at this stage, and that keeps industrial demand for silver high. And if you look at industrial demand for silver, one specific segment, which is photovoltaics, solar panels, they're gaining in particular strength. Out of all industrial uses of silver, photovoltaics is now close to 30% of all industrial uses, and growing quite rapidly. And the newest solar panel technologies use more and more silver loadings per application. So a trend of thrifting that we were seeing in prior years has now come to a rest. And with the volume growth of the solar panels, we're probably going to see that a more than commensurate increase in silver. And silver is in a supply deficit if you include investment demand in the calculation as well. Even if you strip out investment demand, we're getting very, very close to a balanced market. So it's the tightest supplies we've seen in more than a decade. So I think there's a lot of stuff that's supported for silver at this point in time. But just like gold, subject to a few pullbacks in prices as some investors take profit. I guess another
Sticking with the
interesting area in the precious space is the platinum group metals. I
hmm,
don't know if you have any thoughts on those.
it's a very good point, Nitesh, because we always say when gold moves, silver moves, and then platinum moves, and then maybe palladium moves, maybe not. Year to date with platinum, of course, things look pretty good. It's made a bit of a recovery, but it's all about perspective. If you zoom out and look at maybe a 5-year history, platinum is largely flat, maybe slightly up. And of course, you mentioned how silver is drawing a lot of its demand from industrial applications, particularly those related to the energy transition. And we recognize how platinum is another one of those precious metals, which is very industrial in nature and very much one to watch out in terms of its demand from the energy transition for different reasons. So, silver was solar power, to some extent, electric vehicles. Platinum, very much a hydrogen economy metal. And I know in our last episode, we had a guest from the World Platinum Investment Council. We took a slightly deeper dive into platinum, and we made some of these observations how platinum has a role to play in. In the hydrogen economy, in both the production of hydrogen as well as the use of hydrogen in fuel cells. And if we go by some of the numbers that the International Energy Agency published recently, we've seen a strong increase in green hydrogen production capacity worldwide, starting from a low base. Of course, it's a very small market. Green hydrogen has a long way to go. It's perhaps a decade or so behind renewables like wind and solar, but it's seeing rapid growth. And if it continues to see that sort of rapid growth, we will probably start to see a material impact on metals like platinum. So that's the structural case for platinum. But of course, in the near term, There is that correlation effect, like there is for silver. There is perhaps something similar happening for platinum as well. Um, but I'm curious, Nitesh, is that correlation effect limited to platinum? Will we see something happening in palladium as well, or do you favor platinum over palladium on a structural basis?
Yeah, on a structural basis, I think Palladium's having a lot more difficulty. We just came out of the Platinum Week, which was in the middle of May, and Platinum Week, because Platinum and Palladium are mined together, they're basically part of the platinum um, metals group. Um, they're often talked about in the in the same stroke, and it's clear the difference in sentiment towards the two metals. While palladium is actually in a supply deficit as well as platinum, and the deficit is actually widening. So the forecast for deficits in 2024 are going to be higher than the deficits in 2023. You would think that would be a nice catalyst for prices to increase, but no, because palladium is primarily used as a autocatalyst material, um, especially for gasoline cars, and the market does assume that electric vehicles will overtake internal combustion engine vehicles over time. It's generally got more pessimism. Palladium doesn't have the same hydrogen economy story behind it that platinum does. On top of that, um, platinum is gaining market share from palladium, even in the autocat industry. So traditionally, we used to see that gasoline autocatalysts had higher palladium loadings versus platinum loadings. But auto manufacturers have been working on changing that, putting more platinum in rather than palladium because of the historic uh, relative cheapness of platinum over the last 5 years. And that's led to palladium units in demand, or projections for its demand falling. So, what we've seen in May 2024 so far is almost every day this month, we've seen platinum trade at a premium towards palladium. So, we've gone back to the old normal we used to see prior to 2018. So this is quite a big break from what we've been seeing in the last few years, and it's probably going to continue. If we are seeing more incremental demand for platinum over palladium, this trend may be here to stay, and it does look like even the bears in platinum have been shaken out as well. So if we looked towards the position data for platinum in March, we saw record shorts at that point in time. They've largely been shaken out, and with that little bit of a price increase that we saw earlier this month, shorts have been wiped out, and that's why we saw probably an accelerated increase in platinum prices over the last couple of weeks. But that seems to be a familiar story in the commodity markets, right? We've seen something similar in copper, another metal that's reached an all-time high. What are your thoughts on copper, Mobeen?
So copper, Nitesh, is red hot right now, and for those of our listeners who are familiar with copper's actual color, no pun intended, it is the sort of resurgence we've been seeing has been due for quite a while, I guess, in copper markets. Perhaps markets are waking up to the new reality that the world needs large quantities of copper and other important energy transition metals, and supply is probably going to constantly be playing catch up in the coming years. And this dynamic is perhaps not fully appreciated by markets right now. And as you pointed out earlier, that what's happening in the futures markets is very interesting to observe. Recent trends in the futures markets suggest that maybe we are in the start of a new phase. For a long time, we've seen with copper, sentiment has been fairly divided. Longs and shorts have both been accumulating or been in this race, but lately, longs have taken the lead. In the London Metal Exchange, the LME We've seen this happening steadily over the course of this year. Since the start of this year, we've been seeing longs accumulating at a faster pace. In COMEX, for copper, we've seen this happened a bit more suddenly in the last few weeks. So longs taking a slight lead over the shorts in recent weeks. So there are even reports in the last few days in media that physical metal is being moved to COMEX to cover short positions because suddenly people are shifting their sentiment towards the longs. Moreover, on the fundamental side, uh, there is positive news or somewhat positive news coming out of China, encouraging, supportive developments. China is continuing to introduce that piecemeal stimulus in various parts of the economy. Now, most recently, we've heard that China is looking to further support its property market and stimulating the property market with mortgage reforms and so forth. And that, of course, bodes well for copper demand if we see an improvement in sentiment towards the Chinese property sector. We've already been observing good numbers coming out of the Chinese manufacturing sector. Certainly, the Caixin manufacturing purchasing managers indices, a very important measure of month to month manufacturing activity in the Chinese economy, has been pointing to expansion since November of last year. So all these various measures that the policymakers are taking there are perhaps starting to bear fruit, and that is helping lift sentiment towards industrial metals, copper particularly. And of course, like you said earlier, in the on the energy transition front, China is a major player. It's investing heavily. It's making big inroads. Just take electric vehicles as an example. The worldwide EV sales were about 14 million in 2023, and out of those 14 million, almost 60% of the sales were in China. These numbers are coming from the International Energy Agency, and they also predict that the EV share in China this year in 2024 could be as high, the total market share could be as high as 45%. So of course, electric vehicles need a lot more copper. They need a lot more of many other metals, and that's why we're seeing you can't just keep making more of these things and not see a physical impact on the demand supply situation on these metals. And that is perhaps the reality that markets are beginning to wake up to as we see the price action in metals lately. Do you think, Nitesh, there's a broader story in industrial metals to be aware of or be excited about? Because we've seen it's not just copper bouncing back up. We've seen good performance across the board pretty much in industrial metals. Is it copper leading the way and others following, or are just all the idiosyncratic stories coming together?
Yeah, I think you hit the nail on the head when you were talking about energy transition. I think that's one of the biggest driving forces that's lifting all the boats in the industrial metal space. It's incredible that what the example you gave with China and its electric vehicles. China is now producing and selling electric vehicles that are cheaper than their internal combustion engine equivalents. That is a massive game changer in terms of the demand profile. Um, you know, uh, Price conscious consumers are always going to go for the cheapest alternative, so long as the infrastructure can keep up, right? People, when they drive their cars, they want to make sure they can charge somewhere. So, what's the next thing that China is really working very hard on doing is improving its grid infrastructure to allow all these cars to charge. And if you look at grid spending in China versus um, you know, broad macro variables, it's kind of gone off the chart. Grid spending's up here while the economy is middling, which is unlike what we've seen in the past. So there is that kind of secular shift that's been driven by this trend, and we see that to continue. Um, so it's not just copper. Copper is obviously very important for building out that grid and the metals that go into cars, but other things also go into cars and then used for renewable sources for energy, and they're all in greater demand at this point in time. You've seen tin, which is possibly the best performing industrial metal this year. That's risen about 33% since the beginning of this year. So it's even out trumped copper. But copper is obviously the larger metal. It has the most liquidity and therefore has the most investor involvement in terms of capturing that gain. Even metals that um, even a month ago, I would struggle to find a single analyst who would talk positively about nickel. Everyone was talking about chronic oversupply, Indonesia's rampant growth in production. But what's happened as a result of some of the weak prices that we were seeing earlier is there's been supply restraint elsewhere. So we've seen lots of production in Australia, for example, just being mothballed. The miners are saying, well, the price is just not attractive enough to continue producing this metal. And guess what's happened? The price has rallied upwards. Now, we've seen some other supply disruptions. So we saw in New Caledonia rampant riots, you know, likely to disrupt the flow of the metal coming out of that country, and it's the third largest producer of nickel ore, and that's sent nickel prices rallying significantly higher. But as you said, it's not just a couple of metals. It's pretty much every metal, a base metal out there, and pretty much every industrially inclined metal, including silver and platinum that we've already discussed, that are moving upwards. And the thing that's linking them all really at this moment is that recognition that the energy transition hasn't gone away. It hasn't run out of steam. There is still a lot of demand for that upgrade. So that's one thing that's linked the whole group together.
Excellent. So, if we now move on to energy, Nitesh, we know that in oil, we've got the OPEC meeting coming up soon, which of course is an important determinant of oil prices. What are your expectations from the meeting, and what else do you think is driving oil right now?
Yeah, oil, I think, as we've discussed several times on this podcast, is one of the um, stranger commodities out there in the sense that um, a good 45% of its supply is controlled by essentially a cartel, right? OPEC and its partner countries. And they can have a meaningful impact on the world balances, and therefore have a meaningful impact on prices. And so far, over the last year and a half, 2 years, they've been in a period of supply constraint. A lot of that is through voluntary supply constraints. And in total, the OPEC group are holding close to 3 million barrels of production per day off the market, then compared to what they could be producing, and that has kept the market in a small deficit, and that's helpful for prices. But now, if you look at oil prices, whether you look at Brent or WTI prices, they've been trading in a relatively tight range. So between that 80 and $90 a barrel for, and sometimes dipping below that 80 point. In fact, over the last few months, and it doesn't really inspire a huge amount of excitement, right? If you just look at the front end future price or the spot prices, it looks somewhat unexciting because OPEC are there to stop oil prices falling too much on the downside. So there's not keeping any short players particularly excited because they know they got burnt by OPEC. And on the long side, if prices go too high, too much higher than 90, it's very likely that OPEC will release a bit more supply because OPEC are giving up market share to other players. In US, in particular, is taking a lot of the market share. US today is the largest oil-producing country ever. Um, so that range-bound trade could be expected. So is that exciting? To me, yes, it is exciting, even though we have that range-bound trade. Why? Because as an investor in oil markets, if you're investing through futures markets and rolling futures, there's a lot of gains to be had just from the from the roll. The whole curve structure of both WTI and Brent futures are in backwardation. So what I mean by that is the futures curve is downward sloping, meaning that the prices for delivery in the short term are higher than prices for delivery further out in time. And that is very meaningful for a rolling futures strategy investment because as you invest in, say, a 3 month contract in say Brent futures, as that 3 month contract approaches expiry, so as the 3 month becomes a 2 month and the 2 month becomes a 1 month, and if the curve shape doesn't change, the price of that contract is increasing. So by doing almost nothing, just holding on to a futures position, and that's just range trading at the front end, you're just getting price increases. So you're getting a very good return roll on oil markets, even if there's not that much exciting things happening on the front end. But also there is news excitement on the front end. I mean, a lot of it is being driven by geopolitical risks, which are fairly rampant, um, and there is that obvious risk of oil prices potentially spiking higher if there are disruptions to the world movement of oil, and that's just becoming that risk is becoming that much more higher as the war in the Middle East is becoming more prolonged, and it is becoming a lot more of a regional war, with Iran not really fighting the war through proxies, but almost going more directly and engaging in war with Israel. And obviously, this week's news has been that the president of Iran passed away, and that induces another layer of uncertainty in terms of the political uh, framework of Iran going forward.
It's interesting the point you made about rolling of the futures positions. If investors are holding oil for long enough that their positions are being rolled, they get this positive roll return right now. But also, investors who are tactically inclined, who are looking to take long or short positions in volatile markets, they tend to like oil because it tends to exhibit that volatility. But another asset class they tend to like, if they are tactically inclined, is of course natural gas. And natural gas tends to exhibit seasonality. As we record this on the 23rd of May, we see that over the past month or so, natural gas has been very hot. And it tends to do that as we approach the summer months. Of course, demand tends to go up as we go into summer. There's more air conditioning demand, there's more demand from the more driving on the roads and so forth. But of course, it's nowhere near the sort of crisis level gains we saw back in 2022. uh, is it just a routine cyclical seasonal upswing going into summer months that we are seeing with natural gas, or is there something else to be aware of as well, Nitesh?
Yeah, I think when looking at Henry Hub natural gas for the US, I think it's worth putting some context there. In February of this year, we hit seasonally the lowest natural gas prices on record, right? So February, which is a month where you would expect a lot of demand for natural gas for heating purposes, um, if you adjust for seasonal factors, it was at its lowest price in February. Um, demand was relatively weak during the winter. So in the US, while there were a few days of extreme coldness, cold snaps, on average, the winter wasn't that cold, and therefore the demand for natural gas was quite weak. So here we are sitting in May, and prices are recovering, but we're recovering from that really low base. So that's why front month prices have gone up by close to 50% of the past month or so. Uh, and but as an investor, you won't really get that 50%. That's just where front month prices have gone. Just like we talked about with the oil future structure uh, for oil, the natural gas curve is kind of in the opposite state. It's in a place of contango, upward pointing futures curves, which means that um, through the passage of time, as your futures approaches the spot, it's actually decreasing in price. So, that 50 odd percent front month price increase translates to about 15% maybe on actual investable gains, which is still pretty good. 15% of a month is pretty a good place to be. But we're bouncing off those really low periods, low prices. Now, if you look at natural gas in inventory, they look pretty flush and they look way above seasonal average. So, the fundamentals aren't massively strong. But if we go into a summer period in the US that is looking that may be warmer than normal, we could see air conditioning demand increase. And on the back of that, we could see price increases. Additionally, we had seen a large number of outages of liquefied natural gas producing facilities in the US. And when that happens, it means that the natural gas in the US gets just trapped in the US, right? Because there's no way to liquefy and ship it out into other markets that need that natural gas. So that's why another reason we saw weakness in prices a month or so ago. But now a lot of those LNG plants are reopening. They can take that natural gas and ship it outside, and that will reduce the excess inventory of natural gas, which would help prices increase. So maybe some of the best gains for natural gas have already been had over the past month, but should we see abrupt changes in weather, that could be another catalyst for nat gas prices to rally.
So finally, Nitesh, we have agricultural commodities. In previous episodes, we've talked about how cocoa prices were going through the roof. Chocolate lovers will be happy that prices have cooled somewhat recently. Still very high, though, compared to a year or so ago, but they have certainly pulled back from the records that were created in cocoa from what looked like pretty much a vertical line going up at one point. But another agricultural commodity that has been doing pretty well in terms of price behavior, going up, rallying in recent weeks, is wheat. So, what's your take on what's going on with softs and grains, and particularly the appreciation in wheat prices?
Yeah, it's quite interesting to observe that the turn of the tables, right? Last month we were talking about all the softs going in a rally. Cocoa, coffee, sugar, they all seem to be doing well on the back of adverse weather and the disease and all the other factors that drive their crop yields lower. Their prices rallied, and 1 month on, we saw a big dump of rain in a lot of the producing regions, which has allowed for the yields to potentially recover a little. I'd say little because a lot of these things are grown on bushes, and once you've got a damage to the bush, you can't fix it in one season. It takes multiple seasons to for it to recover. So that's why, despite a little bit of paring back on prices, that haven't really collapsed yet. But we are seeing some adverse weather impacts and yield impacts on the grain space. So the US Department of Agriculture put out its latest um, World Agricultural Supply and Demand forecast, the WASDE report. And when it did that, that was a big catalyst for wheat, soy, and corn prices to rally. And what basically they're talking about is the high yields that they'd expected. Um, are really being pared back. There's a little bit of crop damage in the US, especially for wheat, that isn't going to lead to as much production for the end of this year as had been previously expected. So agriculture is quite a weather dependent group of commodities. But when it comes to wheat, corn, and soy, there are those so-called row crops. There is a planting decision that can be made every single year, and if if and then when we go into the new crop season, which is some distance away, on the back of wheat prices in so far this year, farmers can make a decision to reduce their planting of these crops, and so the supply aspect of that can be controlled a little bit by planting decisions as well, which isn't something that is shared in the soft space. You've got to make planting decisions for multiple years in a lot of the soft space. So, but this has been a good month for the grains, because they have been able to participate in what you call the everything rally at the beginning of this podcast.
Great. Well, that wraps up today's episode. We've covered all four sectors, very comprehensive overview. Hopefully, everyone enjoyed it. Thanks once again for tuning in. And if you do want to hear more from us, please subscribe to the Commodity Exchange podcast on whichever platform you're using. And of course, please do take a moment to leave a 5-star rating. You can follow us on LinkedIn or X at Nitesh Shah WT and at Mobeen Tahir WT. And if you want to learn more about commodities, visit Wisdom Tree's website, where we have a wide range of research materials and insights. See you all next time.